For those of you who I have not yet met, my name is David Sung. I'm the president of Nicola Wealth Management, and on behalf of our speakers this evening, John and Rob, myself, and the entire team at Nicola Wealth Management, it is my absolute pleasure to welcome all of you to our 2019 Strategic Outlook. I thought I would begin this evening's presentation by asking all of you a question. What were you doing in 1994? 25 years ago actually marked my first year in the wealth management business. Looking out into the crowd, I see a number of actually relatively young faces who may not have even been born in 1994. But for most of you here tonight, when you look back on that year, what do you remember? Now, I'm no historian, and I'm sure this could be said about just about any year, but 1994 seems to be a somewhat seminal year as far as news events go. 1994 saw the establishment of the North American Free Trade Agreement. Nelson Mandela was inaugurated as South Africa's first black president. Jeff Bezos established Amazon in 1994. And on April 4th, 1994, exactly 25 years ago to this day, Netscape, Mark Andreessen, founded what was originally called the Mosaic Communications Corp. And the first, or one of the first, internet browsers. And it was an early attempt to look at commercializing and capitalizing on what was a relatively new and growing World Wide Web. 1994 was also a pretty big year as far as pop culture goes. Friends debuted as a television show in 1994. Pulp Fiction and Shawshank Redemption, one of my personal favorites, was released. And last but not least, 1994 was the 25th anniversary celebration of the Woodstock Festival, which actually brings me to my point, and another 25th anniversary. You see, 1994 was the year that John Nicola first opened the doors to what was originally called the John Nicola Financial Group. And for those of you here who actually know John well, you were probably somewhat surprised by that. Because knowing John and his history with his rock band Shylock, you would have thought that John may have been one of the performers at the 25th anniversary Woodstock Festival. But in all seriousness, I wanted to take a moment to reflect back and to celebrate and to commemorate 25 years of this past century of building and growing our business. And when I've spent the past few months looking back at our history, there's been one theme that continued to jump out for us as being something that has resonated with our culture. And that has been our contrarian approach, to look at moving where the herd is not necessarily going. Now, being somewhat different and originally a small firm, originally established in False Creek, to today, 25 years later, becoming a national firm with offices on both the East Coast and on the West Coast of Canada, offering advanced financial planning to our clients on an institutional class investment platform that has grown and scaled beyond just offering stocks and bonds, but also to include investments in hard asset, commercial grade real estate, private equity, private debt, commercial mortgages, and other alternative asset classes, including infrastructure assets. It's been taking this contrarian approach and this path that's less traveled that is somewhat difficult, because being different is difficult. In fact, people tend to want to try to conform. It's much easier taking the path that other people have already traveled. And don't get me wrong, because in many aspects of life, that actually is the right way to go. But when it comes to investing, not following the herd is perhaps what can help get results. Most of you here are very familiar with Warren Buffett, and I'm sure many of you have heard this phrase from Warren Buffett or have read it many, many times before. He's considered to be one of the world's greatest contrarian investors. And Warren Buffett, as many of you know, said this: "You might be somewhat wise to be fearful when others are being greedy, and perhaps to consider being a little bit greedy when others are fearful. Let me give you two examples. And circling back to Amazon, some of you here have probably heard the phrase, the Amazon effect. And whether it is Amazon, oh, by the way, in addition to myself, how many of you here actually have an Amazon Prime account? Lots of hands. And it's been accelerating over the past couple of years. So as I was saying, whether it's Amazon or other online retailers, the acceleration of digitized online shopping has had a dramatic and negative impact on retail bricks and mortar real estate. So much so that over the past couple of years and continuing to this day, real estate investors have shied away from investing in retail real estate. So it begs the question, and I think it's fair to ask then, why earlier this year, our real estate group, in conjunction with PCI Developments, through our Nicola Real Estate Value Add Fund, decided in February of this year to purchase Cottonwood Shopping Mall in Chilliwack, BC. Now, this shopping center is a 248,000 square foot enclosed mall, and when we first looked at it, 92,000 square feet of the mall sat empty as a result of Target pulling out of Canada a few years earlier. It takes looking at things a little bit differently to want to consider making an investment where 40% of the rentable square feet is sitting empty. But as our real estate group and PCI looked at this, they noticed that close to 100% of the remainder of the mall was leased to tenants with very well-known brand names, with deep pockets and strong covenants. Names I'm sure you're all familiar with: London Drugs, Dollarama, Earls, TD Canada Trust, Burger King, and Starbucks, to name just a few. In addition to that, through the course of due diligence, PCI and our team was able to secure Jim Pattison's Save On Foods as the anchor tenant to fill the Starbucks space and to actually help narrow the gap and create an even greater margin of safety. The team recognized that there was some development opportunity and density potential to build a new structure on the property and create more potential rental revenue. Last but not least, despite the negative sentiment towards real estate or towards retail, same-store sales for the existing tenants was actually proving to be very strong. And as I'm sure you're noticing, looking at the number at the very bottom of the page, our real estate group is very favorable on the results that they should be able to produce on having made this investment. Now, coincidentally, despite the negative sentiment towards the grocer space, our portfolio management group in the public equity space also began looking at this sector almost 2 years ago. And a name that jumped out to them was Empire, the owner of Sobeys, and at the time in 2016, the recent acquirer of the Safeway franchise. Now, we knew that analysts actually despised the Empire name in 2016, and rightly so, because the company had fumbled the integration of the Safeway franchise. And market sentiment was actually quite negative towards this because they had lost confidence in management's ability to turn the Safeway franchise around. And lastly, on December 14th, Empire came out with its quarterly results, and these results were much, much worse than the market had expected. In fact, on December 14th, when they made this announcement, they said that same-store sales had declined 5.1%. Bang. Over the next 2 days, Empire's stock dropped over 20%, and that's when our team began to buy. In fact, the very next day, on noon of that day, Sean Oy, one of our portfolio managers, wrote to the rest of our team, Q2 results have been worse than expected. Same-store sales have declined 5.1%. The stock is down over 16% this morning. Overall, though, this could be an ideal name to write put options on. Our tactical high-income Canadian fund could write the April 16th puts, which could provide an approximate 17% annualized premium. Now, despite the opportunity that we saw, the market and analysts continued to be negative right to the end of 2016. No one was shopping the Empire stock. The aisles were empty. Analysts were negative on the stock. The public investors were negative on the stock, but we found the valuation quite compelling. Our conservative estimates were that the stock was underpriced relative to the net asset value of the company. And overall, we felt that the short-term issues could be fixed with a new CEO coming on board and that they could turn around the Safeway acquisition. In essence, we modified and updated what we would call our Empire sum of the parts analysis, and we concluded that the share price, in fact, was dramatically undervalued relative to the value of the company. So what has Empire's performance been like since that fateful reporting period in December of 2016? What a difference 2 years can make. Everyone loves the stock. The aisles are full. Analysts like the stock, the public markets like the stock, and being a contrarian investor for us has had a dramatic impact on the performance of our tactical Canadian high-income fund. Since December 2016, Empire's stock is up over 90%. It has crushed the performance of the Canadian stock market and that of the two other largest grocers in the space. Now, being contrarian doesn't just apply to investing. For us, it applies in all aspects of our business. Many, many years ago, we became one of the first investment firms in Canada to move away from a commission-based platform and adopt a solely fee-based approach for our clients, something other firms are just beginning to look at now. And only 2 years ago, the Canadian Securities Administrator had to enact legislation to force investment dealers and the largest banks in Canada to begin actually reporting in a transparent fashion what their clients were earning and the fees that they were paying. Now, over these past 25 years, I've certainly been proud of the firm that we have grown, and I look forward to the next 25 years of working with many of you on the next stage of our journey. Now, let me bring everything back to a much shorter period of time. With that, I'd like to invite our Chief Investment Officer, Rob Adel, to the stage, who will share with us his views on what's occurred in 2018 and what we have to look forward to in the markets for 2019 and beyond. Thank you very much.